In January of this year, the Committee for a Responsible Federal Budget, one of the most respected nonpartisan fiscal institutions in Washington, published a paper with a title that no serious organization uses lightly. The title was, "What Would a Fiscal Crisis Look Like?" Not could a fiscal crisis happen, not is a fiscal crisis possible. What would it look like? As though the question is no longer whether. The question is when. And 2 months later, in March, the same organization published a follow-up paper called Break Glass, a plan for the next economic shock. Break glass, the language you use for the fire extinguisher behind the glass case on the wall that you only smash when the building is burning. The Committee for a Responsible Federal Budget is not a fringe organization. It is chaired by former heads of the Congressional Budget Office, former directors of the Office of Management and Budget, former senators, former Fed governors. These are the people who built the systems that are now failing. And they are telling you, in public in January and March of 2026, that the fiscal trajectory of the United States has reached the point where they are publishing architectural blueprints for what happens when the building catches fire. And the paper describes in clinical detail the cascading sequence that a fiscal crisis would follow. A sharp rise in interest rates on new debt would significantly reduce the value of existing debt, weakening the balance sheets of banks and other financial institutions, undermining confidence and potentially triggering deposit withdrawals or funding stress. This could lead to a series of cascading failures at financial institutions, which could have ripple effects across the economy, making it difficult for individuals and businesses to make payments or receive loans, and sparking a wave of defaults, rising unemployment, business failures, and foreclosures. That is not my language. That is a direct description from the Committee for a Responsible Federal Budget in January 2026, and every single precondition they described is present in the American economy right now. Every one. 2082 banks are sitting on a dual threat, and nobody is talking about it because the last time we talked about it, 3 banks collapsed. Klaros Group, a financial advisory firm, analyzed approximately 4,000 U.S. banks and found that 282 of them face the dual threat of heavy commercial real estate loan exposure and potential losses tied to higher interest rates. These are not the mega banks. These are community banks and regional lenders with less than $10 billion in assets each. The banks that fund the small businesses in your town, that hold the mortgages on houses in your neighborhood, that process the payroll for the local employer that keeps your community alive. And Brian Graham, co-founder of Klaros, told CNBC that most of these banks are not insolvent or even close to insolvent. They are just stressed, and that communities would be affected not by dramatic closures, but by the banks choosing not to invest in new branches, new technology, or new staff. That sounds mild until you understand what it means in practice. A stressed bank does not lend. A bank that does not lend starves the businesses that depend on it for working capital. Businesses that cannot access working capital do not expand, do not hire, and in many cases do not survive. And the communities those businesses serve lose the economic base that supported their tax revenue, their school funding, their emergency services, and their property values. The first bank failure of 2026 has already happened. Metropolitan Capital Bank and Trust in Chicago, a $261 million institution, was shut down in January by the Illinois Department of Financial and Professional Regulation due to what the acting director called unsafe and unsound conditions and an impaired capital position. The bank had a 1.62% net equity capital ratio and $43 million in liabilities against Federal Home Loan Bank advances. The failure cost the FDIC's Deposit Insurance Fund $19.7 million. And the conditions that produced Metropolitan's failure, heavy commercial real estate exposure, thin capital, and a rising rate environment that degraded the value of long-duration assets, are the same conditions that 282 other banks are currently sitting on. The reason nobody on financial television is discussing this loudly is that the last time the media started talking about stressed banks in March 2023, Silicon Valley Bank collapsed within 72 hours of the conversation going public. The stigma effect that the Federal Reserve cited in court when it fought to keep borrower names secret is real. When depositors learn their bank is on a stress list, they withdraw their money. The withdrawal accelerates the stress. The stress becomes a crisis. The crisis becomes a failure. And the failure spreads confidence damage to every other bank on the list. That feedback loop is why the regulators, the Fed, and the financial press are all deliberately quiet about the 282, and the silence is precisely what makes the situation dangerous. Commercial real estate is the slow-motion bomb that nobody diffused because everybody agreed to pretend the timer stopped. After the pandemic emptied office buildings across America, the commercial real estate market entered a crisis that has not resolved, it has simply been deferred. Banks that hold commercial real estate loans agreed to extend maturities, modify terms, and avoid foreclosure proceedings on properties whose values had fallen 30 to 50% below their loan balances. The Federal Reserve, the FDIC, and the OCC issued interagency guidance in 2023 encouraging banks to work with commercial real estate borrowers rather than force defaults. That guidance was not a solution. It was a sedative. It allowed banks to carry impaired loans at values that do not reflect reality, to avoid recognizing losses on their balance sheets, and to present a picture of health to depositors and regulators that the underlying asset values do not support. Approximately $1.5 trillion in commercial real estate loans are maturing between 2024 and 2026. When a loan matures, it must be refinanced, and refinancing a $50 million office building loan at 7% interest when the building is now worth $30 million and the vacancy rate is 40% is not refinancing. It is default recognition. The borrower cannot afford the new payment. The collateral does not cover the loan balance. And the bank that holds the loan must finally acknowledge the loss it has been pretending does not exist. The wave of maturities has been described by industry analysts as a wall of debt that the market must absorb. And the market's capacity to absorb it depends on interest rates being low enough to make refinancing viable, property values stabilizing or recovering, and tenants returning to occupy the vacant space. None of those conditions exist. Interest rates are elevated, and the Fed cannot cut them because inflation is running at 3.3%. Property values in many central business districts remain 25 to 40% below 2019 peaks. Vacancy rates in major office markets are at or near historic highs, with some cities reporting vacancy rates above 25%. And the remote work revolution that emptied these buildings is not a temporary pandemic artifact. It is a permanent structural change in how white-collar work is organized. The buildings are not coming back, the tenants are not returning, the values are not recovering, and the $1.5 trillion in loans that were written against those buildings must now be resolved, and the resolution will not be orderly because the losses have been hidden for so long that when they will surface all at once. The extend and pretend strategy that regulators encouraged in 2023 was based on the assumption that conditions would improve before the loans matured. Conditions did not improve, interest rates went up, not down. Office vacancy stayed elevated or worsened, and now the maturity wall is here, and the loans are coming due against collateral that is worth a fraction of what was lent. Commercial property values in some central business districts have fallen by 40 to 50% from their 2019 peaks. A building that was valued at $100 million in 2019 and used as collateral for a $70 million loan may now appraise at $55 million. The bank's $70 million loan is secured by $55 million of collateral. That is a $15 million loss that the bank has not yet recognized. Multiply that scenario across 282 banks with heavy CRE exposure, across thousands of commercial properties in dozens of cities, and the aggregate unrealized loss in the banking system is measured in the hundreds of billions. And unlike residential real estate, where individual homeowners absorb the loss through foreclosure and personal bankruptcy, commercial real estate losses are absorbed by the banks themselves, which means the losses flow directly into the banking system's capital base, reducing the system's ability to lend, reducing the flow of credit to businesses and consumers, and creating the exact conditions that the CRFB described as the opening act of a cascading financial crisis. Every safety buffer that was supposed to catch America has been drained, depleted, Oregon dismantled simultaneously. Here is what makes the current moment different from every previous period of economic stress in the last 50 years. In every previous crisis, America had at least one functioning buffer. In 2008, interest rates were high enough that the Fed could cut them to near zero, providing massive monetary stimulus. In 2020, the federal government had enough fiscal headroom to borrow $5 trillion in emergency spending. In 1979, the Strategic Petroleum Reserve was being built and filled. In 2001, the national debt was 31% of GDP. In April 2026, every buffer has been consumed. The Federal Reserve cannot cut rates because inflation is 3.3% and rising from the Iran war energy shock. The March CPI showed the worst monthly spike in 4 years. If the Fed cuts into rising inflation, they risk de-anchoring inflation expectations, which the CRFB specifically identified as one of the triggers for a fiscal crisis. The federal government cannot borrow its way out of a recession because the national debt is already at 100% of GDP. Interest payments have crossed $1 trillion per year, and 3 rating agencies have downgraded the country's credit. The CRFB warned that responding to an economic downturn with borrowing alone could transform the downturn into a fiscal crisis. either because the borrowing sparks a debt spiral or provokes a market reaction as investors lose confidence. The Strategic Petroleum Reserve is at its lowest level since 1984, with 403 million barrels, down from a peak of 727 million, and existing congressional mandates will drain it further to 238 million by 2028. The FDIC Deposit Insurance Fund took a $19.7 million hit from just one bank failure in January, and 282 additional banks are under dual stress from commercial real estate and interest rates. Consumer savings have been depleted, with 29% of adults dipping into savings in the last quarter of 2025 alone. Credit card delinquencies are at decade highs. Auto repossessions are at 2008 levels. Student loan delinquencies are at record pace. Consumer sentiment is at the lowest level ever measured. There is no buffer left. The Fed is constrained. The Treasury is overleveraged. The SPR is drained. The banks are stressed. The consumers are depleted. The rating agencies have already downgraded. And into that environment, with every single safety mechanism already exhausted, a war in the Middle East has just closed the most critical energy choke point on Earth and sent inflation spiking in a direction that makes every remaining option worse. That is what the edge looks like. Not a dramatic event, not a single catastrophic day. A slow, systematic exhaustion of every cushion, every reserve, every failsafe that was supposed to prevent exactly this convergence. And beneath all of the financial stress, the physical infrastructure of the country is crumbling in ways that compound the financial fragility. The American Society of Civil Engineers gave the nation's infrastructure a C- grade in their most recent report card. Over 42% of all bridges in the United States are at least 50 years old. 1 in 3 bridges need significant repair or replacement. The water system requires $434 billion in investment over the next 20 years just to maintain current service levels, and more than 6 million lead service lines remain in use across the country. The power grid, as I have documented in previous videos, is operating at capacity with no reserve margin in many regions, and FERC has warned that the loss of just 9 critical transformers could trigger a coast-to-coast blackout. Every one of these infrastructure deficits represents a latent crisis that could be triggered by a weather event, a cyber attack, a supply chain disruption, or simple age and neglect. And when that trigger occurs, the financial system that would normally fund the emergency response, the credit markets that would finance the reconstruction, the federal budget that would appropriate the aid, will all be operating in the degraded, over-leveraged, buffer-depleted state I just described. The infrastructure crisis and the financial crisis are not separate problems. They are two faces of the same systemic underinvestment. America stopped maintaining its physical foundations and its financial foundations at the same time for the same reason. Short-term convenience was prioritized over long-term resilience by political leaders who would not be in office when the bill came due. The bill is now due. Institutional erosion has gutted America's ability to respond, and both parties participated in the gutting. Standard & Poor's did not downgrade the United States in 2011 because the math was bad. They downgraded because the institutions were failing. Their statement cited the weakening effectiveness, stability, and predictability of American policymaking and political institutions. The math was already bad in 2011. It had been bad for years. What triggered the downgrade was the realization that the institutions that were supposed to fix the math were incapable of doing so. 14 years later, every major rating agency has reached the same conclusion. Moody's, in May 2025, said successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits. The CRFB's break glass paper in March 2026 exists precisely because the organization has concluded that the normal legislative process is incapable of producing a responsible fiscal response to the next shock. They are pre-building the emergency plan because they do not trust Congress to build one in real time. And the institutional erosion extends far beyond fiscal policy. The Federal Reserve is under political attack. The DOJ served subpoenas threatening criminal indictment of Chair Powell in January. 3 former Fed chairs compared the situation to emerging market authoritarianism. Federal workforce reductions have hollowed out the agencies that administer the programs millions of Americans depend on. The government shutdown that began in October 2025 disrupted data collection so severely that the October unemployment and inflation numbers were never calculated. Never. The Bureau of Labor Statistics was unable to conduct the surveys. The most sophisticated economy on Earth flew blind for a month because the institutions that measure it were shut down by a political standoff. SNAP benefits in 25 states were threatened. Medicaid verifications were delayed. IRS processing backlogs accumulated. The administrative state that actually delivers government services to citizens was degraded, and the degradation has not been fully reversed. And when the next shock hits, the response capacity of the federal government will be slower, thinner, and less competent than it was in 2008, which was already slower and less competent than it was in 2008. America is not just on the edge because the numbers are bad. America is on the edge because the institutions that are supposed to catch a falling economy have been weakened to the point where their ability to catch anything is in doubt. And this institutional erosion has real, measurable consequences that go beyond abstract governance concerns. The FDIC itself, the agency whose entire purpose is to maintain depositor confidence in the banking system, has seen its leadership politicized, its staffing reduced, and its deposit insurance fund depleted by past failures. The DIF took a $69 billion hit during the 2008 crisis. It took a $23 billion hit from the Silicon Valley Bank and Signature Bank failures in 2023. It is now absorbing losses from Metropolitan Capital in 2026. And the DIF's ratio of reserves to insured deposits, which is the fundamental measure of the fund's capacity to absorb future failures, is being tested against a backdrop of 282 stressed banks, $1.5 trillion in maturing CRE loans, and an interest rate environment that continues to degrade the value of long-duration assets on bank balance sheets. The FDIC is not in crisis, but it is in the same condition as every other American safety buffer, adequate for normal times, insufficient for the simultaneous convergence of stresses that is currently unfolding. The fire extinguisher is not empty, but the building has 5 fires burning simultaneously, and you only have one extinguisher, and the instructions on the side assume you are fighting one fire at a time. Cascading failure is not a theory, it is a documented mechanism, and every triggering condition is present right now. The CRFB paper described the anatomy of a fiscal crisis in precise, sequential terms. It starts with a loss of market confidence in U.S. debt. That confidence loss manifests as higher interest rates demanded by buyers of Treasury securities. Higher rates on new debt reduce the value of existing debt held by banks, pension funds, and insurance companies. The balance sheet damage triggers funding stress at financial institutions. Funding stress leads to deposit withdrawals. Withdrawals lead to bank failures. Bank failures lead to credit contraction. Credit contraction leads to business failures, layoffs, and foreclosures. Foreclosures deepen the real estate crisis. The deepened real estate crisis damages more bank balance sheets. And the cycle feeds itself. That is not speculation. That is the mechanism that operated in 2007 and 2008, triggered by collapsing subprime mortgage valuations. The CRFB explicitly draws the comparison. They note that when a similar phenomenon occurred in 2007, it led to a global financial crisis where hundreds of financial institutions closed, housing values declined by 1/4, output shrank 4%, unemployment rose to 10%, and the economy took years to recover. The parallel they are drawing is not between subprime mortgages and today's commercial real estate. It is between the mechanism, the cascading failure sequence, and the conditions that activate it. And the conditions that activate it are high government debt that creates anxiety about fiscal sustainability, rising interest rates that degrade existing asset values, institutional stress in the banking system, and an external shock that triggers a sudden reassessment of risk, government debt. 100% of GDP, interest rates, elevated and unlikely to fall due to inflation. Banking stress, 282 banks on a dual threat list, $1.5 trillion in CRE loans maturing, the first bank failure of 2026 already behind us. External shock, a Middle East war that closed the Strait of Hormuz, sent oil to $120, broke the ceasefire and triggered the worst monthly inflation spike in 4 years. Every triggering condition is present. The cascading mechanism that the CRFB described in clinical, institutional language is not a hypothetical scenario they are warning about for the future. It is a description of the present tense. The question the CRFB paper asks, what would a fiscal crisis look like, may already be answering itself, not in one dramatic day, in a series of incremental deteriorations, each one individually manageable, collectively unsurvivable, and interconnected in ways that most Americans will not see until the cascade reaches their own bank account, their own mortgage, their own job, and their own retirement. The distance between stressed and collapsed is shorter than most people understand. In 2008, the transition from Bear Stearns showing signs of stress in March to Lehman Brothers filing for bankruptcy in September was 6 months. From Lehman's bankruptcy to the deepest point of the recession was another 6 months. 12 months from early warning to economic devastation. And in 2023, the transition from Silicon Valley Bank reporting unrealized losses to Silicon Valley Bank being seized by regulators was 48 hours, 2 days. The timeline of collapse is not measured in years. It is measured in the speed at which confidence evaporates. And confidence, once lost in a financial system, does not return gradually. It returns only after the wreckage has been cleared, the losses have been absorbed, and a new equilibrium has been established. That process took 4 years after 2008. It took 18 months after 2023. And the CRFB paper warns that a fiscal crisis triggered by a loss of confidence in U.S. government debt would be categorically worse than either of those events because the collateral at the center of the crisis, Treasury securities, is the foundation of the entire global financial system. When subprime mortgages collapsed, the damage was contained to the mortgage market and the institutions exposed to it. When Treasury securities lose credibility, there is no asset class that is not affected, because every other asset class is ultimately benchmarked against Treasuries, the dollar, corporate bonds, municipal bonds, money market funds, bank reserves, insurance company portfolios, pension funds, sovereign wealth funds, foreign central bank reserves. Every one of them holds Treasuries as a foundational asset. A crisis centered on Treasuries is a crisis centered on everything. And the country whose institutions were supposed to prevent that crisis from ever becoming possible has spent 14 years being warned by rating agencies, fiscal watchdogs, former Fed chairs, and its own CBO that the trajectory leads here, and nothing has changed. The debt has grown. The deficits have widened. The institutions have weakened. The buffers have been drained, and America is on the edge. Not approaching the edge. Not heading toward the edge. On it. Standing on it. With the wind picking up, and most Americans are watching television and being told the economy is strong because GDP grew last quarter and the unemployment rate has not yet spiked. GDP grew in the third quarter of 2007, too. The unemployment rate did not spike until September 2008. The indicators that most Americans rely on to feel safe are lagging indicators. They tell you where the economy was, not where it is going, and where it is going based on every leading indicator published by every credible institution in the past 90 days, is toward the edge that the Committee for a Responsible Federal Budget just spent 2 papers describing in detail, so precise that it reads less like analysis and more like a premonition. Share this video with everyone you know, because the people who understand what the edge looks like are the people who can step back from it, and the people who do not understand are the people who will be standing on it when the ground gives way. And the ground does not give way with a warning, it gives way with a silence, the silence of a bank that stops approving loans. The silence of a company that stops posting job openings. The silence of a neighbor who stops talking about their retirement plan. The silence that fills the space where confidence used to be.